I'm joined by Henry Whorwood of Beauhurst, and we're going to be giving you a summary of what the fiscal outlook and what the fiscal statement means for taxpayers and entrepreneurship in the UK, as well as give you a bit of an oversight as to the economic backdrop. We'll be covering really in this presentation the context of what the Chancellor was faced with going into this event, some of the backdrop over the last 6 months, which has led to what has been probably the most speculation and comment around any fiscal statement or budget that I've probably seen in my lifetime. What were the real highlights and lowlights in that budget, and what really the outlook is going forwards, both economically, fiscally, but also for real life entrepreneurship on the ground as well. So moving on, we'll make a start. So as with anything, I think it's always really important to provide some context to what was probably the most important in real terms budget of probably the last 20 years. If we cast our minds back to March 25, which was only 6 months ago, we were faced with a relatively shaky fiscal and economic outlook. Growth was already starting to wane in the midst of the NIC changes that was announced in the November 2024 fiscal budget. And of course that was meant to be a growth budget, but it didn't really hit the mark in terms of even the OBR's outlook for growth. There were rate cuts predicted throughout the rest of the year. 2 to 3 rate cuts were predicted by the market, which has broadly played out this year, both in the US and here. But what we were seeing was what I call, the great exodus of wealth in the UK. We'd already seen that probably as far back as 2 years ago, but it really began to accelerate in the run up to the budget as through fiscal changes that had previously been announced, many taxpayers were being encouraged to leave the UK in a variety of different ways. And what has made this particular fiscal statement or budget really profound is that the government itself has what many of us would call a supermajority. So in theory, there aren't really, politics aside, there aren't really any constraints on the legislation it can pass. But of course, summer then happened, and the pre-recess period and the post-recess period, and within that period, we saw a hugely embarrassing and detrimental welfare reform bill, 80% of which was either deleted or amended, and actually ended up costing the government money rather than saving it money, which really told bond markets this summer that this government was incapable of cutting spending. That led to my second point there, which is that spiking across the summer, partly as a result of that, and a number of other actions taken by government as well. We've known for some time that productivity in the UK has been falling. The OBR has been, or it's always, I think it's fair to say, taken a relatively bullish view of productivity in this country. Finally, and through no fault really of Rachel Reeves per se, they've taken a bit more of a cautious outlook at this point, which she had to face up to in the pre-budget period. And with that being said, they did give her credit for some of the bond market relief that was faced in the post-reporting cut-off period as well. So some of those slightly lower yields in the weeks after the OBR cut-off, she was given some relief for. And much of the debate in the news as to whether Rachel Reeves lied or simply misled the public in the last few weeks is very much centred around what the OBR and the government were aware of throughout this pre-budget period. So moving on. And again, just a little bit more context before we have a bit of a discussion around where we are sort of economically. What's really staggering is that, notwithstanding the doom and gloom, we are seeing tax receipts up considerably year on year on year. And we've been seeing this throughout the Conservative Parliament and very much so through, the first year of this Parliament. Income tax receipts up 10%, NIC up 8%, VAT up 4%. But much of this increase in tax receipts in reality derives from what we call fiscal drag. So taxpayers being moved into the higher rate tax bracket, whilst the exemptions and reliefs effectively remain the same. And those bandings, for example, in income tax and VAT thresholds remaining the same. The really worrying thing about this, because at face value, those numbers look great, the really worrying thing about this is that notwithstanding the increase in tax receipts, it just simply isn't translating into an increase in fiscal headroom. And of course, this is the big debate with the government right now and the OBR is, was there a black hole? Did we need to have a big series of tax increases in this budget, similarly to last year? And the reality is, whichever stance you take on that, we simply aren't generating fiscal headroom from the increase in tax receipts, and that's a really, really big problem for the country. And that really is the big context in which this budget was set.
So this is a chart of ours at Beauhurst. One of the ways in which we try to analyse the private company economy and the effects of the budget and other political decisions for entrepreneurs and business owners. This chart starts to point to where we are in the cycle for these businesses. In particular, on this chart, this is in every business in the UK. Obviously, this is looking at the sort of high growth entrepreneurial subset. So these are companies that typically use or all have used some amount of external finance in order to fuel their growth. These are the companies that were talked up, at least, by Rachel Reeves in the budget. There was more reference to entrepreneurs, to starting a business and scaling a business than there have been in previous budgets. Indeed, when in the actual speech itself, she said some very empathetic things about how hard it is to be a founder. And the chart here is showing that we've got a record number of companies that have raised this kind of finance. But we're also seeing the blue line there, an increase in the number of businesses failing. Now, in an entrepreneurial ecosystem, you expect some level of failure. It's natural, that's the venture capital model, is that you have some big successes and a decent rump of failures. But it's more this yellow line that is potentially presents an issue for the entrepreneurial ecosystem in the UK. These are basically the companies that haven't exited and haven't died. Another way of thinking that these are companies that are competing for the interest from UK corporates. Basically, investor money goes into the businesses, those businesses grow, and then look for an exit of some kind. There are several routes to exit, but the most common one at the moment is to another UK company. So IPOs are a type of exit, but that market is pretty dormant at the moment, and perhaps we'll come on to that later in the discussion. There were some changes in the budget that might start some changes on that, although I'm a bit skeptical. Companies do sell abroad, and those tend to be the most eye-catching transactions. But if you are an entrepreneur, your route to exit, or if you want to take the sort of macroeconomic view, the way in which we get growth as a continuous sort of engine of jobs creation and wealth creation in the UK is the completing of the the circuit. So raising that external finance, but then you need an off ramp, and that 22,000 number shows that there's record competition for that off ramp. How does this link back to the budget? Well, if your most common route to exit is sale to a UK corporate, you need those corporates to be feeling confident and like they have the money to invest in these businesses. If you don't have them doing their part, then the whole entrepreneurial landscape, the key engine of growth in the UK, gets gummed up. And ever since actually last year's budget, with increases in employer national insurance, we have seen corporate activity remain flat, which against that previous graph, the level of that 22,000 number means proportionally we're seeing a decline in that exit activity. So absolute numbers are flat, which is what this graph come back to, but ignore that spike quarter. We're seeing basically flat activity, and when corporates are sort of surveyed on what their M&A strategies are and their M&A activity is, they are planning less.
And Henry, sorry, quick question for you there. Obviously, there's been a huge amount of speculation around this fiscal statement. The economic outlook in the UK is not great, and we'll come on to what the OBR said a bit later in the presentation. To what extent do you think now, positively or negatively, the certainty of having this fiscal statement, this budget in the last week, will start to give those people deploying capital, whether it be other corporates, private equity, VCs, the confidence to press the button and deploy capital? So, now that they have the certainty on what terms they're doing it.
Yeah, so certainly going into any budget, you get some slowing down of activity, a bit of wait and see. So with the budget in the rearview mirror, that will have some effect on confidence, or at least if not confidence, the environment in which they're operating is known rather than uncertain.
Yeah.
But the overall sort of pattern of what was in the budget is one of increasing costs for corporates and indeed for individuals. So I think it will unlock some activity, but it won't be a sort of great tidal wave of activity, because the spare cash, if you like, is still being pressed and tightened on a lot of different sides. But that was what we saw in this spike here on the graph. So this graph is showing exit activity, acquisition activity of high growth firms, and it was a direct budget effect. Sorry, the dips in 2020 are the direct pandemic effect, but that huge spike is actually an effect from the previous budget, but not in a good way. So these are deals that were basically rushed through ahead of the changes to capital gains tax that were in the previous budget. So the ability of the budget to really move the market is certainly borne out by this graph. But although maybe for advisors it was a slightly different picture, but for the entrepreneurs doing the deals, these were stressed deals done at basically a good deal for the buyer as much as the seller, because people were trying to avoid the increases in CGT. Those rates are still there, and those will still be naturally depressive on overall activity.
Sure. So should we have a look at what the OBR actually said as a result of the budget? One of the key headlines which Rachel Reeves jumped on was the fact that they'd increased growth from around 1% to 1.5%, but that wasn't really a reflection in reality of the economy doing well or beating forecasts. It was really the OBR releasing the upside of some underweighted assumptions that they didn't have enough data on in the prior fiscal statement. And that's borne out when you look at the future years. the future year forecasts of growth, which have been reduced for every consecutive year going forward from 26 through to 2030, and 2026, I think, the memory reduced from 1.9 to 1.3, so some quite considerable falls after this initial upfront release. Rachel Reeves, perhaps quite rightly, has built in some fiscal headroom, irrespective of the debate going on in the media, into the budget. You've got this 22 billion now of headroom, but that's based on a number of very, very stern assumptions around, whether we can meet growth forecasts, productivity forecasts, and very importantly, whether our bond yield assumptions and our debt forecasts actually hold good. And there are a number of reasons as to why that may not, which we'll come on to a little bit later. But what is clear, and the OBR makes this very clear in its statement, is that that headroom is extraordinarily sensitive and vulnerable to even the most smallest of shocks. And there's a number of shocks which could happen, some of which are completely outside of the Chancellor's control. What's also very, very interesting about the budget, and the OBR do pick up on this, is that there are some very, very significant spending increases in the next 3 years, but most of the tax increases really take place from 27, 28 onwards. So we're going to see national debt go on a bit of a roller coaster ride over the next 2 to 3 years, and there's a question mark over how bond markets react to that as they see that playing out in reality. And again, if we end up having to borrow more than expected because of growth and productivity, then that really will be a vulnerability to our yields. But really, it's really very much a buy now and sort of pay later budget in reality, in terms of the way it's structured. Just to mention inflation as well, most people are expecting rates to fall over the medium term, but what is very clear, and I think this is going to be borne out globally in the US as well, is inflation is staying stubbornly high, and there's a number of very good reasons for that. And this is going to keep rates generally higher for longer, without some very significant shocks to the financial complex.
Neil, if I could just build on a point there about the sort of backloading of the increases, which is sort of one of the more unexpected parts of the budget, one of the more interesting parts. Politically, the choices there are quite interesting. I wonder if, from some angles, they've been thinking about the long term. The party is going to be in power for many years hence. If I was being an optimist and trying to give the Chancellor sort of full credit, I wonder if this is partly the setting out of a worst case scenario to then be able to improve on that over the rest of the Labour in government. That may be just an overly optimistic reading, but I think there could be a political strategy behind that.
I think there definitely is a political strategy behind that, and whether it's beating those forecasts or more just an acknowledgement and a reflection right now of the fact that this government fundamentally is extraordinarily weak. It has a supermajority and it can't pass spending cuts in its core initiatives and its core legislation. And I suspect it will be hoping that it can improve its stance, its poll numbers. The moderates in the party can regain their position and not be at the mercy of the backbenchers, which it has been, at least for the last 8 months, post the welfare reform bill failure. And whilst I think it's fair to say that this was a budget of the backbenchers, they conceded pretty much all of the territory and all of the points that the backbenchers really demanded as a result. I wonder whether they are hoping that they can regain the momentum and push back on some of these sort of fiscal fiscal policies at the back end of the cycle. Whether they can do that is anyone's guess, but they really are, in many respects, pushing the big decisions, the big economic questions, the big tax questions, and also to some extent the big political problem. They're just kicking the bucket down the line. Definitely. So should we move on to sort of what did the budget actually say, sort of fiscally at least, and then we can have a bit of a chat, Henry, maybe about what this means for entrepreneurship in the UK and what the outlook there is. Some of the highlights or the headlines here, as everyone knows, it was widely thought, and I had felt for many months, the headline 2% increase in income tax across the board was, at least at the higher rates, was going to be implemented. We now know that was the case, but due to some of the tempering down of forecasts by the OBR, it wasn't quite, Rachel Reeves didn't need to be quite as aggressive to build in that headroom that she needed. So what we saw was a 2% income surcharge on investment income, including dividends and interest, and on property income as well. Salary sacrifice arrangements from April 29 are going to be capped at 2,000. So effectively, there won't be that same NIC relief via payrolls for any contributions above 2,000 from that point. And that's definitely an area, Henry, going back to your point, that I think is highly susceptible to a potential change as the political climate gets better or potentially gets better. And we head towards the back end of the parliamentary cycle into election season. It would be a nice one to, it would be a nice giveaway at that point. Unfortunately, the freezing allowances for a further 3 years from April 28 to 2031, the fiscal drag is hugely damaging to household finances, but most people don't realise the impact that freezing the bans and allowances for income tax and other taxes has. But it's very, very significant indeed. There was the introduction of a very small scale mansion tax. Whether that opens the door for a wider tax on wealth in the future is an open question. But for those homes worth more than £2 million, there is a consultation on how this will actually happen and how valuations will be conducted. But there is a local council tax surcharge on homes above 2 million and 5 million. There's been some improvements on the EMI and EIS rules, which I know we're going to cover in some details and talk about entrepreneurship. And one of the key demands of those backbench MPs was the two-child benefit cap being scrapped, which was a bold move in the wake of the failure of the welfare reform bill in the summer, which caused this government so many problems economically and politically this year. So income tax, I don't want to dwell too much on this, but as we know, the basic and higher rates of dividends have been increased by 2%, but the additional rate taxpayers, so those earning more than £150,000, they won't suffer the additional 2%, and property and savings income at all levels will have this additional 2% surcharge. So the rates of tax going from 20 to 22, 40 to 42, and 45 to 47%. There's been some ISA, there's been some tinkering with ISAs. So anyone under 65 will only be able to save £12,000 in a cash ISA going forwards, with the balance set to stocks and shares ISA, but the full limit will be retained for those over 65s for obvious reasons. And as I mentioned already, the personal allowances will remain frozen for an extra 3 years. Inheritance tax, this was the one that was really topical with clients. There have been so many rumoured changes on the back of a major change into the way we look at inheritance tax last April, and swathing changes to business property relief and agricultural property relief that are due to come in from April 25 next year. There's been some tinkering with the way the 1 million allowance works between spouses, which is due to be introduced from next April. They'll now be transferable between spouses. So in theory, a spousal unit can get a 2 million allowance, between them. And there was some effectively some clarity more than anything else provided as to how pension death benefits will work from April 27, when almost all pensions will be brought within the scope of inheritance tax going forward. Capital gains tax remained broadly unchanged. This is the one tax which most people do speculate about prior to a budget, but I think it's fair to say that this year it was the one thing that wasn't really speculated about to any great extent. The headline rate of 24% remained. There were some changes to the rules around employee ownership trusts, which cut the relief from 100 to 50%, and some nuances and small changes to the way that the reorganisation relief rules work for share exchanges, which I won't go into on this call. But broadly, capital gains tax remains a bit of a constant in this budget. I don't know whether, Henry, you want to cover off some of the EIS and venture capital trust changes.
Yeah, this was some of the most clear-cut good news in the budget. The increases to EIS are things that we, alongside people like the Startup Coalition and the EIS Investment Scheme Association, had been pushing for. Basically, these numbers had stayed where they were for quite a long time, and so partly just needed increasing to bring them in line with the effects of inflation, and also recognizing the realities of scaling these businesses. Once you're on that capital raising pipeline, the requirements can be quite high. So businesses are able to raise more in a given year, and the lifetime limits have doubled. There was a bit of give and take in that the relief for VCT was decreased at the same time. There is a reasonable rationale for that. These schemes are meant to support risky businesses and risk-taking entrepreneurs. VCTs had always had a broader remit and were able to invest in some more liquid assets, and therefore arguably needed less incentivization than EIS. So there is a reasonable rationale to what happened there. And the EMI changes had been asked for a long time. Basically, companies that were growing fast were effectively being penalized because you could sort of bring in the scheme and then 1 or 2 years later find yourself outside of the limits of the scheme. So basically the size of the company can now be much larger, was still offering shares to its employees under the EMI scheme. So both of those quite good changes overall, I think.
Well, just one question for you, Henry. When I speak to EIS funds and some of the more evergreen funds and VCTs in the market, what they say to me is they're struggling to raise their own rounds from from investors, and they're struggling to raise as much money as they were 5 years ago. And of course, if high net worth individuals are not investing as much into EIS, for example, or they're struggling to do these raises, the question is why? Because these reliefs are quite generous and can be quite lucrative as well in an upside scenario. So I guess my question is, are the government really solving the right problem here? Was the problem in that we needed to increase these limits in terms of the value sizes of the business, or is the real problem the fact that many investors just don't see or don't have the positivity or the confidence in the British economy right now, and therefore they see these investments as fundamentally too risky?
So I spoke to some funds, some SEIS and EIS funds in the aftermath of the budget last week, and they were saying that they had seen decent inflows almost immediately after the budget was finished, because these remain some of the best tax reliefs out there. If you are trying to adjust your tax position, these are a good way of doing it, and the changes in the budget only confirmed that or further pushed you in the direction of these schemes. So there was some movement there. I think you're right, though, at a slightly more macro level, and it comes back to a little bit that graph that we showed a few slides ago about that record number of companies that have received investment and are still trading. Basically, another way of saying that is that there isn't enough liquidity in the market for this asset class. There aren't enough people buying these companies. Too many of the investors who are already in EIS funds or directly holding EIS shares themselves haven't seen exits, or haven't seen enough exits, or haven't seen exits at high enough prices. That is ultimately partly a trend seen around the world at the moment. There is sort of systemic issues. There was so much money into the market in the pandemic that it creates this liquidity gap. That's sort of to be expected with everything that happened during the pandemic. But there are particular UK versions of that problem. One is that confidence point. I think it's absolutely there. You know, UK corporates aren't doing as many transactions as you kind of need them to be doing for this whole cycle to work. And also, we don't have the same diversity of liquidity options that they have in the States, for example. There are secondaries funds in the state. There are some here, but not very many, and way fewer proportionally than in the US. And we should also have functioning IPO markets and more MBOs, and actually more employee ownership trust transactions, which have been really knocked out of the water by quite a small the small change that you alluded to on your previous slide. So there hasn't been enough holistic thinking about what the off-ramp is for the entrepreneurial ecosystem. There's a lot of efforts to crowd money in. Yeah, we haven't even talked about R&D tax credits, Innovate UK, all the other things that help people start a business and to some extent scale it. But if you want that sort of unfettered growth, then the capital, both financial and indeed human, needs to be able to cycle through the system, and that there's not enough work on the off-ramp.
Yeah, no, I'd agree with that. Yeah. And I think the comparison to the US market, where there's a wealth of liquidity, and the sources of funding are so diverse now compared to the UK, is a really good analogy. So in the spirit of time, if we move on to the next slide, where we'll just cover very quickly the mansion tax that I alluded to earlier. I call this the backbench tantrum because it was one of the wealth, one of the attacks on wealth that the backbenchers in the Labour Party really did want to see in this budget. And really, it's a very much a token gesture, really. It'll be an adjustment to the council tax bands, which I assume will then be recharged through to central government through a tinkering with grants and things like that. We've yet to see that. But it'll be a 2,500 surcharge for anything over 2 million, and 7,500 for any property values over 5 million. As a country, we've resisted what we call backdoor wealth taxes in real terms like this for decades. And one of the concerns I would have, and one of the concerns that many clients will have, is is this just a very small stepping stone as we start to push forward a wider agenda around wealth and how that's taxed. But these rules are going to be subject to consultation and may well be watered down as some of the practicalities of implementing a regime like this become apparent. So what is the macro outlook from the fiscal statement? Well, I've already mentioned we've built this headroom of 22 billion, with many of the benefits back-ended, or many of the tax benefits back-ended towards the end of this government cycle. And I alluded earlier to some of these assumptions being really, really vulnerable to even the most minor of shocks, particularly to yields or dents to growth. And what is clear is that our problem is not raising tax revenue. Our revenues are going through the roof. We're at the highest effective rates of tax since the in the whole post-war period. Our problem is fundamentally growth. We're not getting additional tax receipts from increases in our growth forecasts. And even if they were, it's just not translating at all into fiscal headroom. So we're having to pass the burden on to taxpayers who are being squeezed. I mentioned earlier, this is very much a buy now, pay later budget. That's a very risky strategy, because what we know is bond markets might now and they do seem to be in the days following the budget, pricing in, a high probability that the government will continue to be able to meet its forecasts and pay its debts. But as it starts to see national debt spiraling and the cost of money increasing, in terms of our national interest bill, will that in itself have an impact on yields as the next 3 years go on or move on? And I say that because there'll already be pressure on our own bond yields from things completely outside of our control. There's a very big refinancing to go through in the US next year. It's over $9 trillion that President Trump has to or the Treasury Secretary rather has to refinance. We don't have any big debt maturities next year other than really we've got to finance our deficit fundamentally, but that's about it. But that flood of paper and that short-term paper in the market has already had an impact on our yields this year, and there's a very good chance it will do going into next year as well. And I think that for me, that's one of the biggest risks that she faces to her assumptions. It's things that are outside of her control. And the macro outlook as well is that the Chancellor is really standing from a position of weakness. She with a number of key initiatives having already fallen down. The most notable we've mentioned already being the welfare reform bill. She's really had to rely on the notion of increasing taxes rather than a more broadly balanced set of spending cuts to sit alongside those tax increases. And just covering off what the budget didn't do, and also what I think the media isn't really covering at all at the moment. Investment in AI and data and energy is something which I think is very under discussed in this country, and not even I had until maybe 4 or 5 months ago an idea of how much capital is being deployed into the US through both internal government investment and external investment into data centers, energy, AI. And we have the ability in this country to be a real player in that market, but we're absolutely nowhere right now in terms of government support and investments in that area. The North Sea, we're seeing an entire basin in the space of 18 months being wiped out, up to 100 or 150,000 jobs expected to be lost, many already having been lost, and halving of production in the North Sea. I saw some horrifying data yesterday that by 2030, maybe only 3% of our gas demand in the UK, compared to 30% only 10 years ago, will be serviced from our own resources that are sitting there. There was a big opportunity to temper our energy profits levy, which currently sits to tax energy companies at 78%. Currently, where there is no windfall in terms of where energy prices currently sit, there's a really big missed opportunity there, which is going to significantly put more pressure on that basin. And there's no real broad shoulders for all. So, one of the cornerstones of Labour policy has been, everyone bearing the brunt and everyone bearing broad shoulders broadly equally. And that isn't really happening, because when you look at data, what is quite clear is that the top 5%, their effective tax rates have been increasing steadily for the last 10 years. And the lowest earners and middle earners the lowest earners have been falling. So there hasn't in real terms been those broad shoulders that the government has been talking about. Business reliefs have got considerably worse, both throughout the Conservatives' tenure and this government's. But the slight cause for optimism here is what history tells us, and what history shows us throughout the last 50 years is that when effective tax rates do hit a peak or an equilibrium, governments are forced to focus on growth. as a matter of priority, whatever your political leaning. And you tend to see at that point business relief starting to get better. And my hope would be that some of the token gestures that have been given in the EIS and EMI changes are just the first part of a wider encouragement of risk taking, and a wider sense that risk taking in this country needs to be rewarded in success cases. And that's certainly what I both expect to see and hope to see over the coming years. And what I think also, what this budget didn't do is really support fundraising, deal making, and individuals taking risk, which I think is something which is becoming increasingly more difficult in the current environment. And just going back one slide, because I purposely missed the last slide, just to move on to some of those points. I already mentioned that some of these assumptions in the OBR are extremely vulnerable. Stock markets are extremely vulnerable right now, and there's a lot of commentary around the risk due to the AI bubble that has been created, and given the weighting of some of those companies in the market, that poses a real challenge. And although stock markets are not the economy, they do have the ability to dent confidence significantly when we see big course corrections in markets. I won't talk about bond yields anymore because I think we've covered that in the session already, but in my view, they're the Chancellor's biggest headwinds as we go into the next year. And I've mentioned the AI bubble already. That again, I think that from a markets perspective is one of the key areas of risk.
Is coming back to Neil's points on sort of support for entrepreneurs and what that means for deal making. I mean, Neil, to your point, or your hope rather, that there might be more to come in months and years to support entrepreneurs. It is interesting to note that with the budget, they published an entrepreneur's prospectus, a separate document trying to outline everything that they're doing already for entrepreneurs, and sort of collecting together the changes in the budget that had meaning for entrepreneurs, which is an interesting move. It was partly the result of Alex de Pledge, who was the Chancellor's entrepreneurship advisor, who is an entrepreneur herself, and actually really, every time I've heard her speak, really understands the realities of growing and financing a business. So I think what success there was in the budget for entrepreneurs was in big part due to her. However, the publication of this sort of separate document comes across quite defensive, and I think it's in response to some of the trends around people leaving. There's a suggestion that because the UK is making it less attractive to be an entrepreneur, entrepreneurs are leaving. That is definitely factually happening is provably happening. What it means economically is harder to say. But I think that's what led to number 11 effectively saying defensively, but look, we do all of these things for you across the SEIS, EIS, Innovate UK, R&D tax credits. We do all these things for you. So it had a sort of defensive tone of people being ungrateful. But if they're leaving, it doesn't matter. And the reason they're leaving is the taxes out the other end. If you keep increasing CGT, keep getting rid of entrepreneurs relief or business asset disposal relief, the huge risks taken by entrepreneurs just aren't worth it, or rather are better worth it in a different country. That's a bit of an aside to these graphs we've got up here. Basically, this is showing all fundraising by UK private companies, entrepreneurial businesses. It's cumulative of all stages, so seed deals and Series A and beyond are all included in this graph. And basically, you can see a very clear pandemic effect with the spikes in 2021, and then a cooling off from there. And we are still cooling off. That's despite increased government interventions, more money for the British Business Bank and similar. The graph of spend from the government into these kinds of deals against this graph of activity shows you that the proportion of activity that's made up for by the government is only increasing, which maybe arguably is starting to have some distorting effects or crowding out rather than crowding in private investors. On the right-hand side, you see the same data but presented quarterly. Again, you see an effect from the previous budget, where so much was warned about CGT changes. That was well into the market, so people just slowed down deal making to a very low level. The final bar there is Q3, and we're actually seeing a reasonable performance, better than, frankly, the pessimist in me would have expected, because you do often see a Q3 dip anyway, because of the summer that slows down deal making. So a reasonable number of deals got away, but overall the picture is not the rosiest one when we look at every stage. But if we move on to the next slide, I can be rosier on this data, because this is showing the first deals done by companies. So when an entrepreneur gets its first round from friends, family, and angels, typically an SEIS deal, unless they've raised the money from abroad. And again, same pattern here. It's the annual chart on the left and the quarterly one on the right. The annual one shows a similarish trend of some pandemic highs and then a slowdown, although interestingly not in the amounts being raised. So that does tell you that the average first deal is increasing. On the quarterly picture, you actually see a huge bounce back in recent quarters. Not only a huge amount invested per the quarter, but the deal rates, as in the rate at which deals are being done, have really climbed into the most recent quarter. That is being largely driven by AI. A lot of those companies are AI companies. So despite all of the sort of cyclical things affecting the investment market into private companies that we've discussed on this call, basically investors, sometimes it's new categories of investors, sometimes it's existing investors finding what liquidity they can to put it into AI opportunities. Basically, there's an exigency to investing in this technology. Maybe you could put that another way and say it's the fear of missing out is motivating deals in this space. This graph effectively shows the supply of entrepreneurs into the market. When an idea goes from just an idea or a self-financed idea into an externally financed idea, so an idea with some traction. Once they do these deals, this is when the companies start engaging properly with the economy by hiring people, renting office space, things like that. So an increase in the supply of entrepreneurial businesses here can only be a good thing. Whether that recovery continues is obviously a pretty pertinent question, but for now there's strong activity in the AI sector.
And Henry, just one other question as well. Obviously, we know that private equity have trillions sitting on the sidelines globally, ready to deploy, and there will obviously, with cost of money being where it is, be a real push to try and deploy that at the earliest possible opportunity, subject to risk. On the slightly bigger ticket deals in the private markets, one of the things PE would typically look to is the extent to which listings are being well underwritten and getting away really well. And what we have seen is NASDAQ get some really good listings away, certainly in the last quarter, which may partly explain some of, particularly in the AI space, why we've seen that big jump, particularly in the last quarter. What's your sense in this current quarter as to where private equity stands in sort of deploying its capital right now into businesses?
Yeah, it's still pretty reticent, if you like. I think it comes back to that same liquidity challenge, that the path to the off ramp is not clear, except for the very top sort of 5% of investment opportunities. The people who are sort of successfully shooting for the moon, a whole sort of panoply of different paths open up for those companies, and private equity will meet those deals as part of the funding mix. For other companies, there's still a wait and see mode. So when we were talking earlier about some of the differences between the UK and the US, that is one of the ways in which we currently differ. So in the US, the exit pathways for businesses include a greater mix of private equity. So if you're a US company and you're looking to exit, a US corporate is still a common route, but actually US based private equity is a common route to exit, whereas about 1 in 10, maybe sometimes a little bit higher in the UK is a private equity doing the exit. So the activity that they are doing is more amongst themselves of the sort of secondary exit. So private equity selling on to larger private equity. We do see a lot of those transactions, but for the entrepreneurs, unless they're the very best, the cream of the crop, they're not. Private equity isn't currently engaging with them so much.
Sure. And just to say, if anyone has any questions, please do pop them in the Q&A, and we'll answer those before the end of the session. In the meantime, I just had another question for you, Henry. And obviously, valuations in general, forget parking AI to one side, which is a market of its own. Valuations arguably aren't where they were in the pre or even the post-pandemic, immediately post-pandemic levels. Obviously, when you see valuations fall, you get private equity start to be a bit jittery around timing and deploying capital, and you get business owners taking quite considerable time sometimes to adjust to the new valuation, the new world of valuation, or the terms upon which they could expect to enjoy upon a successful deal. To what extent are we still in that sort of closing of the expectations gap in valuations, terms, and the way in which deals are structured? And to what extent do you think, or is your sense that is a problem as well at the moment, it's holding up the deals market?
Yes, I think there have been some improvements. The sort of synthesizing is quite a challenge, because not only do you have the sort of valuation as one of the vectors by which capital meets a business, but you do have the terms in the transaction as well. So you can get sort of favorable headline valuations, but once you factor in the preference stack or other rights that have been acquired during the deal, then it starts to temper that headline valuation. What we do know is that the use of sort of aggressive extra terms outside of the valuation is probably on a downward trajectory at the moment. So the deals that are getting away with fewer less aggressive preference stacks and things like that than say 12 to 18 months ago. But certainly valuation multiples are trending down as well. So there is a bit of a correction. Possibly also the distribution is changing. We do see some deals get away with decent multiples at the moment as
it's
well.
It's very sector specific, isn't it? I think.
Yeah. And so I think that presents one of the challenges for an entrepreneur who no matter how sanguine they're trying to be about their own valuation prospects, the allure of someone in an adjacent or nearby sector doing a particular deal can be, well, I guess it's just envy inducing, isn't it?
Yeah, no, I agree. And I guess in summary, just going back to the budget, what we've really seen is the Chancellor get a budget away that broadly balanced the book, provided some indication that business reliefs and risk taking could look a little bit better in the future from a policy perspective. But at the moment, we're not seeing the economic backdrop and the economic forecast to really give confidence to those investors and entrepreneurs in the market to take more risk. And I think that's the other side of the coin that we're just not quite seeing at the moment more broadly. I don't know whether anyone has any questions.
Neil, Henry, that was absolutely brilliant. Thank you. I think you've given us a very thorough walkthrough. There are a couple of questions that have come up, and I mean, I do think overall it feels like a tougher environment for founders and owner managers. what, if anything, should they be looking to address in the short term to make sure that they're making the best decisions now in light of this budget?
I can hazard it's a big question, that one, but I can hazard a go from our side. I think there are still it's going to depend on the sector, but there are still a lot of generous schemes. You know, we pointed to EMI and ES becoming more generous. The SEIS scheme is generous still if you're in the right sector. R&D tax credits are generous still in the right sector. So yeah, maybe it's a slightly facile comment, but looking at all of those available options for funding. And there are also sort of changes coming down the line that might make banks and other debt providers a bit more adventurous, and therefore considering other types of, you know, the more conventional types of financing might become a more attractive proposition over the coming months as well.
Yeah, what I would say is that, you know, whilst the economic backdrop has changed considerably over the last 18 months to 2 years, fundamentally our tax system, albeit confidence in it, has been dented, particularly in the last 6 months. Our tax system really hasn't changed significantly for businesses over the last 5 years. We have seen some positive changes as well as some of the more neutral to negative changes that we've seen more recently. So many of the same things that we would be talking to clients about in terms of whether it be tax efficiency or growing businesses successfully, are still as good today as they would have been 5 years ago. What I would say is, you know, take advantage of all the reliefs available. You know, and whether that be at corporate level or in terms of incentivizing key people within the business. You know, we've seen some of the changes in this budget are far more accretive to helping with that, with some of the EMI legislation around share options, and on a fundraising level with some of the greater flexibility around EIS. So just take advantage of that.
Excellent. And I think, you know, it's not sitting back and letting it happen, is it? It's getting curious, have conversations, and look at maybe a little bit broader for other incentive schemes that maybe you weren't aware of. I think everyone just has to work a little bit harder to create those opportunities at the moment. Gentlemen, I'm conscious of time. Thank you so much for your contributions today. For those on the line, if you do have any other questions and you'd like to follow up, please do drop us a line, either at BKL or at Beauhurst, and we'd be delighted to answer those questions as they come through via email. All right, thank you very much, everybody.
Thanks, everyone.
Thank you.